Hi, and welcome to Midas Investing. Today we're going to be taking a look at Ulta Beauty, ticker ULTA. Ulta is a fast growing retail company within the ever growing beauty products and services space. They've recently gone through some major valuation revisions due to both the rising interest rates as well as major questions about just how much growth they have in their future. So let's take a look and see what we can find out. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So hopping right into their most recent investor presentation from August, we can come down to one of these slides here where they first give us a little look at kind of the value proposition that they offer. In general, they have a pretty wide selection of a huge amount of beauty products surrounding many different brands within their store. So obviously beauty is a pretty wide and growing space, but they can benefit from all of the different brands that are benefiting from the growth of beauty as a category, as well as they've made some larger expansions of their stores over the last decade, but also expanded into a variety of Ulta dedicated sections within Targets, a pretty useful joint venture between the two companies. They've also managed to expand their footprint within the digital space and also have grown a loyalty program, which makes up the vast majority of their sales over the last decade. So coming down to take a look at the markets that they operate within, $104 billion of the US beauty products dedicated space. This doesn't include the salon services portion of the market that they also operate within. We can see the categories that this market makes up in general, split between hair products, skin products, cosmetics, fragrance, bath, as well as other. And Ulta themselves offers products all within these categories. You can also see the distribution of the different channels that they come within. Specialty beauty being the category that Ulta themselves would fall in, but obviously a lot of makeup is sold at grocery stores, online, drug stores, department stores, all of these being competitors of Ulta. One thing that I really liked about this, because I've seen some other segmenting off of the beauty markets and what market share the Ulta has within that space. But I really like the way that Ulta actually displays this market, which a lot of companies like to display their market as big as possible so that you can argue that they'll be able to get a large market share of it. But I think this is actually really helpful in Ulta's case because it really bifurcates their competitors in different markets, such as department stores versus e-commerce versus drugstores, which depending on how people categorize the competitors for Ulta, might get discluded from the overall category. So coming down further in the presentation to talk a little bit about their customer, they actually give quite a lot of interesting information surrounding the beauty customer in general, as well as their own customers at their own stores. So they have this chart here where they talk about this general concept where there is beauty enthusiasts versus non-beauty enthusiasts. So people who really identify with makeup and using beauty products as part of their everyday life versus people who just use it because they kind of sort of have to. The split between it, they say, is about 2 for 1 of enthusiasts versus non-enthusiasts. But the interesting part is about the split between the amount of dollars being spent on those products, not services it specifically categorizes here. I imagine beauty enthusiasts would probably be the vast majority of the services as well. But 83% of the spend dollars being focused on those beauty enthusiasts. So you really see a concentration of the dollar spent on the people who are really, really interested in these products, which is going to lead into some of the other details surrounding their customers. Coming down even further, take a look at some of the things that they display as part of their competitive advantages. First, they show their beauty categories, separations off those categories that we were talking about. You can see, as I was saying before, they have a pretty wide diversification across the categories. Obviously, though, still a lion's share coming from cosmetics, and then obviously a pretty wide variety of brands across different price points, which allows for a wider audience of customers from different classes and different portions of the population to come in. And also coming down, they talk a little bit more about their digital channel versus the different store locations they have, as well as the Ulta Beauty, which I kind of already touched on a little bit. But one other thing that they touched on, which we didn't cover too much, was the services. We talked about the products portion of the markets, but they do talk about the sizing of their service markets, not necessarily on this slide, which I will say it's about 50% of the size of the total product markets. But that means a 50% more of total size if you include the salon services. One thing about the services when it comes to Ulta is that they don't really have a very large market share in the services specific subcategory. I think they were reporting like 1 to 2% market share within the services, while reporting more like 9 to 10% market share within the products, giving them an overall market share of like in the 7 to 8% range, depending on the year in the overall category. You'll see that when we get to the spreadsheet a little bit earlier. But here they talk about why services is a useful differentiator nonetheless. It may not be a huge portion of their business, but it's something that gets people in the door. A lot of people will come there specifically for the services, and then they will spend a much higher portion on other services that they offer, as well as products, and as well as it says here, 50% of guests purchase retail products the day of a service. So it's like, well, you come in for one thing, you see the thing on the shelf, you're looking to buy more products. So it's a good product that allows, or not a product, it's a service, but the services allow for them to differentiate themselves from just a typical beauty store that doesn't offer these services in the first place. And then they have their loyalty program. We'll definitely talk a little bit more about this when I get into the spreadsheet, but I'll at least mention right here that they talk about in the most recent year, 95% of total Ulta Beauty sales are made by Ultimate Rewards members. So really just the rewards members and the growth of these members becomes a pretty solid proxy for the growth of the revenue of the company overall. So hopping into our spreadsheet, we'll take a look at some graphs of some of the data surrounding their market share, as well as the information around their members, as I was talking about. Here you can see the beauty products and the salon services market that they were talking about grouped together over the years, over the whole decade. I was able to give the information going back over the whole decade, which is very useful. And then we can see Ulta's market share of the combined grouping here. As you can see, as I was saying before, I think I said 7 to 8, so I was wrong with that. It's more like 6% as the combined category. But you can see about 6% in the most recent 2 years, and it grew pretty consistently over the whole decade, only taking a dip in 2020, which I think is pretty interesting. So coming over here to the next graph, we have the stores over time. In the dark bars, we have the stores. You can see pretty dramatic growth over the decade, which reached a pretty strong tapering off point in 2019, 2020, really started to slow down the growth, still growing, but at a much slower rate. And then the lighter blue bar we have at the back is that each of these years within the annual report, they also state a goal that they believe would be an appropriate saturation point for the amount of stores that they could hit, or at least a midpoint within it. And at various points, they also raised that target at some of these years. The last time they raised it was in 2018, up to about 1,600. So you can see we're still at a relatively low point relative to that stated goal, and obviously they could raise that goal a little bit more in the future. But that gives you an idea of just how much restraint and discipline that they've had in terms of opening new stores over the decade. And then the line I have right here is kind of a way to kind of categorize the saturation of the stores. I think I took the loyalty members that they have, which we'll look at a graph here shortly about that at each of the points over the years, and then I scaled it against the square footage in total over all of their stores. I did it against the square footage to account for the fact that some of the stores might be of different sizes, which for the record, the average size per store over the decade remained dramatically stable. I don't have that on a chart because of the fact that it was just so stable. I felt that you guys could just trust me on that probably. But nonetheless, you can see the loyalty members per square foot, which was growing over time with the same time frame in which the members themselves were growing, and you'll see that shortly. But then it kind of reached a point where I don't know about this kind of 2.5, 2.6 range. It dipped in 2020, but then came back up to that 2.7 range. It was a little bit higher at 2.8, but I almost feel like this kind of stability we're seeing here in terms of this ratio is probably a good guide stone for where the amount of stores that they could possibly have in the future relative to loyalty members. At that point, you would have to make some sort of projection about the growth of loyalty members or growth of stores they're in. So coming over to the loyalty members, we can see that right here. Here's the loyalty members in millions over the same decade. As I was saying before, they had a very, very strong growth of the loyalty members, so which explains that growth in that ratio in the initial stages, but then reaching a strong tapering off point at the same time as when they were still having pretty significant loyalty growth. Very strong loyalty growth in the last 2 years. Obviously, yes, they did have a little dip in 2020. And now this line up here is the factor that I had mentioned in the presentation, the percentage of the revenue coming from loyalty members as a result of total Ulta revenues. And you can see when they opened the loyalty program, it started off at closer to 80%, but that raised over time, becoming close to that kind of mid 90s range as early as like 2018, 2019 timeframe. So you can see what I meant by this being a very, very strong proxy for where the actual growth of all the revenues are going to go, minus about 5%. Now, this graph right here is just a few other interesting metrics related to the beauty customers kind of behavior that I wanted to comment on, which we already saw one slide that kind of commented on a little bit of it, which was the slide that had pointed out that 65% of the beauty customers are enthusiasts and they make up about 80% of the dollars spent. Well, they included those statistics going back as far as 2018. So I tried to show that that number wasn't an anomalous thing in 2022. It's been a pretty consistent trend within the beauty category as a whole. And then they reported only in the last 2 years an interesting statistic that I kind of wanted to comment on, which was that they had mentioned that about 75 or 76% of all the revenues of Ulta were purchased on in-store purchases. They weren't being done online or on e-commerce, which you can kind of look at the flip side of this. Many other valuations or people talking about stock analysis will point to the amount of e-commerce as a competitive strength. I'm actually looking at the amount of customers that are only doing in-store purchases, the amount of members, I should say, actually, it's the amount of members that are making purchases only in store, 75 to 76%. Shows that Ulta being a specialized beauty store, I think does actually hold a significant competitive strength. So now coming together to see how all of this builds into the revenues themselves, we have the actual total revenues by year for Ulta going up right here. Very, very strong growth going from 2.6 billion in 2013 up to over 10 billion in 2022. But then backdrop against that on the other axis, we have the revenue dollars per loyalty member over the course of the year. So you can see this is effectively the amount of money that's being spent per member. And then we were seeing that the total amount of members is growing at a certain rate. And then the amount of members that can grow is a factor of the saturation of the amount of members per store. So you can kind of see how we're working to build this model together. And the rates of growth for the dollars per loyalty member is only a little bit faster than kind of a typical inflation rate, like inflation maybe plus 1 or 2% on depending on any given year, which I think makes it a much more predictable type of growth rate to project going forward. So coming over to take a look at the model that I built for the company, starting up at the top, I have the beauty products and salon services markets that were listed by Ulta and the combined category of beauty and salon right here with the market share that Ulta has of them as a percentage listed right here. They grew as a combined entity at 4.8% compounded over the last decade, but it's interesting to note that the products grew at 5.4% while the salon services grew at 3.9%. And it wouldn't shock me to see that difference almost expand over the next decade a little bit, maybe even see beauty and products grow at 5 to 6%, and salon services grow at even a weaker percentage of it. But I don't know, that's kind of just like a general random thought I have on that. But I made projections about where the total group would go over time based off of this historic growth rate, a little bit of a crapshoot estimate, but getting me 6%, 4%, and 2.7% compounded for those cases, leading me to 224 billion in the bear case to possibly 307 billion in the bull case. And then I'm using that as kind of a guide stone for my projections for the revenue of Ulta and the market shares that that would imply over the next decade. So let's take a look at like the other factors. We have the stores over time listed right here. And as I had kind of made before assumptions, I was going to make my assumptions about where they could grow over time based off of kind of like the ratio between the amount of stores they have and the guided amount of stores they think they could get up to. So I'm assuming that possibly in the bull case assumption that they could actually probably increase their guided assumption a little bit more and possibly even hit that target in the bull case assumption. And in the bear case assumption, I'm actually going to assume that maybe where they're currently at is the cap point. Maybe they've already reached their total saturation, right? Like that would be, I think that's possible. And then my base case, I chose to basically make halfway between those two assumptions. So that gets me anywhere between 1355 in the bear case and 1890 or so in the bull case, about 1620 in the mid there. And then looking back on this, I also have the revenues per store. It's interesting to see how much that's grown over time as well. About $7.5 million per store in 2022. And then I'm making calculations based off of the square footage, which, like I said, you can assume I'm relying on just kind of longer term averages. It's a remarkably stable average, the square footage per store. And then we have the loyalty members and that growing over time and the dollars per loyalty member. This is a little bit more of a crapshoot of exactly how much more loyalty members we could possibly have. But like I said, I'm making my assumptions based off that ratio we've had recently. So I'm assuming that over those last 5 years, saw about 2.6 as a kind of a ratio of loyalty members per square footage. And so I'm going to imply that we can possibly keep that same level. And based off the stores that I'm projecting to get to, assuming they have the square footage that they've typically had on average, that would get us to anywhere between 34 million and 56 million in loyalty members. Worth noting that in that bear case, we actually assume a drop in the loyalty members. So that could be one area in which I'm being pretty conservative. So between that, then we have to make an assumption about how much dollars per loyalty member is going to be spent per year. As I had said before, we saw that the compounded rate over the last decade was about 4.4%, which is approximately inflation plus about 1.5% per year. So I feel pretty confident in assuming that we can have kind of similar levels over the next decade, maybe a little bit closer to inflation, but still maybe a bit more inflation. On average between these assumptions, I have about 3.8%, but it's as low as 2.4% and 5.4% on the high side. You could argue that I'm being a little bit conservative here too, but I prefer to be a little bit more conservative when it comes to these types of assumptions. But that gets me to anywhere between $275 per loyalty member compared to 241 most recently, and possibly upward to 369 dollars per loyalty member. Again, this is 10 years from now, so we have to assume inflation has occurred at a commensurate rate there. But like I said, I think I'm possibly being a little bit conservative on that end of things. But anyway, take those factors all together, we end up with a bear case assumption for revenues of just under 10 billion, which puts us less than we had in the most recent year. And in our bull case assumption, we end up with 21.7 billion. My base case being 14.5 billion. Average between all those cases being about 15.4 billion. So there you go. That's my assumptions for where revenues could go for Ulta. As I have hopefully shown that I think I'm being a little bit conservative in terms of my loyalty member estimates and possibly my dollars per loyalty member estimates. I think I'm not being that conservative though when it comes to the stores. So I think that maybe balances out with that overall. Okay, a couple other factors I wanted to comment on before putting the valuation together, which is profitability. We can see that their EBIT margin here in the black line has in generally been pretty stable over the last decade, minus a little dip there in 2020. But in general, it's actually been stable with a slight rise upward over time. Even prior to 2020, we were still kind of generally seeing a little bit of movement in that sense. And that's bolstered by the fact that the gross margins themselves were having a slow drift upward time, which has also been commiserately a little bit more noticeable since 2019. The green line we have, which is the unlevered free cash flows against that. To reason why I kind of wanted to show these lines comparative to that is that we also had much more store growth over time in the earlier years, the first 5 years, which slowed down as I showed you on those charts, which would imply much less capital expenditures in the most recent few years, which is why we see the free cash flow margin drifting upwards towards the EBIT margins over time, showing that when they're not actually making new stores, they're actually going to become a fairly high free cash flow or yielding industry. They just aren't doing that when they're issuing new stores. And I think this is relevant to making projections for our estimates because our estimates are assuming a relatively slow pace of issuing new stores in general. And so I feel that in general, while EBIT margins will probably stay about the same over the next decade, and in the terminal case, I'll probably assume it gets a little bit more conservative. My assumptions about capital expenditures are probably going to get better and better over the decade over time. Also wanted to make some comments on pricing before we put the full valuation together, which is to say that Ulta has traded pretty rich over the last decade, coming both from its relatively high growth rates as well as the generally high moat status that the market has generally treated as. I think that it will likely be rated pretty generally highly because of it being seen as somewhat of a high moat retail company in general, but its growth rates are slowing down pretty significantly. So I think that we do have to take into account some decreasing in terms of multiples over time. But nonetheless, get the point is my terminal multiple will be a little bit higher than some other terminal multiples because of the fact that it does get a little bit of a moat rating from me. So coming together to look at the full valuation, here we have the revenue growth paths put together. In the short term, I have the expectations relatively in line with the analysts, and then we move towards our terminal cases in our bull, bear, and base cases in our model. I have the base case and the bear case both being a little bit more optimistic than they were on the model. As I had shown, I thought I was being a little bit more conservative than possibly necessary in some of the pricing terms. And then I also pulled back the bull case back a little bit too, because I thought maybe you could argue that the store count was maybe a little bit more bullish as well. So I kind of pulled in the revenue estimates a little bit more towards the center, you could argue, but nonetheless, our average still kind of maintains in approximately the same space. You can see the cumulative growth cases on the charts right here and incremental growth cases per year. Then coming over to take a look at operating margins, on average for the first 5 years, our operating margin ends up being about 13%, 13.2%. For the next 5 years after that, it drops down to just under 12% and then drifting to about 11.7% in the terminal case. So you can see, as I was talking about, will allow for pretty consistent margins over the 10 years, but dropping towards a little bit lower than they've been historically in the terminal case, showing some competitive weakness over the longer term. Coming down, you can see those operating margin cases with the operating income quartiles remarkably stable in general, I would say, with the income distribution right here, pretty bunched up around the 2 billion mark. Then taking a look at capital assumptions, as I had said, we're assuming that they're going to be pretty capital efficient over the next decade. That's kind of like the one changing saving grace comparative to the financials over the last decade, seeing returns on invested capital for the next 5 years of about 40%. And then we see it likely actually accelerating possibly even to 45% for the years after that, due to, again, very, very cheap capital relative to their profitability. Coming down, you can see the returns on invested capital right here, and then the capital investment, you can see right here in general being negative over the decade, as I was kind of implying, moving towards a more stable terminal case, but the free cash flow distributions bunching up around 1.5 billion. And coming over to take a look at terminal assumptions, you can see my terminal multiple implied in general is around 17 to 18. You can see some bunching in the lower teens, but some options to being closer to 20 as well. With the distribution of outcomes in between the interquartile range between about 325 and 425, with the median case being around 380 or so. The expected value about 375. The fair value distribution right here. So yeah, honestly, a pretty decent distribution, wide across many different values, which comes, I think, from the wider uncertainty surrounding the growth rates over the terminal years, as well as I think the terminal multiple is a bigger question for this valuation relative to some other ones. Expected returns you can see distributed right here. And finally, coming over to the summary DCF page, you can see the summary assumptions right here. Our current fair value estimate being about $395 per share. It's currently trading at 75th percentile of our value distribution. So definitely on the outer edges of valuation, though with some assumptions being a little bit more bullish than mine, you can definitely see this still within a reasonable valuation range. Due in large part due to the higher terminal multiple that I've given it, we do end up with relatively low expected returns at only about 7.4% currently, though it is only a little bit overvalued. So if you're looking to hold it in terms of asset terms, this could be a good entry point, but I myself would be opting for higher expected returns than this going forward. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for Ulta Beauty, a very highly requested company and a very, very high quality company within an interesting industry. I was very happy to finally take a look at it, and we'll definitely have to keep our eyes out for maybe those lower 300s or something like that before we would be interested in adding it to our own portfolio. I'll catch you on the next valuation. Bye.